Welcome to the weekly market view from Capital Spreads. I'm joined by Bill Hubard of markets.com. Welcome, Bill.
Thank you, Angus.
Good to see you again. You're looking particularly autumnal today.
Especially this lovely day we're having, you know.
Well, exactly. I think the winter's here to stay now, isn't it? But that doesn't seem to have, well, actually, the start of this week, it has cast a bit of gloom over the markets. A big sell-off across the board, all risk assets suffering. It almost felt like there was a real change in sentiment altogether. Do we think that this is the beginning of maybe possibly a wider sell-off?
I think so. For the simple fact is, we had seen a very strong move down in Spanish yields, okay, on more than 200 basis points. We've seen an incredibly strong move in the euro above 131. And this was all based on the Spanish bailout acceptance. Well, I think most people feel now, the question is it bailout, meaning B-A-I-L out, or B-A-L-E out? And I think most people feel after Rajoy got Galicia voted for him, you know, they still have the election in Catalonia on the 25th, feeling that anything done from Spain now will be in next year. Okay.
Really? Okay, yes. So they've expectations now pushing it into 2013 and they'll bail out.
We're running out of days.
It's very interesting though, because obviously there was all that pent-up expectation that they would have requested bail out very soon. So your view is maybe 2013.
Yeah, I think so.
Okay, that's very interesting. But on the upside to that, obviously the FMC last night was saying that no news, but confirming obviously rates until mid-2015.
And I don't think anybody, maybe I should use this term, in their right mind, should have expected anything but what we got exactly from the FOMC. Because remember, we have the US presidential election on the 6th of November. The central banks are always apolitical. Now, you know, so, excuse me, they didn't say anything we weren't expecting. You know, they said, you know, the housing market improving, the labor market still sluggish, and we had sort of an interesting non-farm payrolls last month in the States, okay? And probably the big drop from 8.2 to 7.8 was the quarter ending in possibly 30,000 missing people out of the state of California. So my call for next week's non-farm payroll is like 130,000. I really haven't even thought about what the rate could be, but I mean, it's still not going to be 7.5 or 7%. One of the things that the Fed has been looking at, and is it going to be a situation where, and I think we got reiterated last night, mid-2015 before they make any interest rate changes.
Yeah, okay. I mean, it's probably not going to have much of an impact on the election.
No.
But I suppose another good bit of good news, obviously we've seen that big move to the downside earlier this week, but has come out of the UK. So GDP, wonderful to see that finally we're out of recession. Finally we can all breathe a bit easier. But I mean, what does that mean for? So you know, we are seeing the FTSE just a rally on the back of that a little bit. But do we think that we see this bouncing growth sustainable?
Well, I think what we'll see, all we've got to do is go back to the second quarter. Remember, the first number was minus 0.7, and then it was revision and revision. I was in the plus 0.7% for this month, so it came in much, or this quarter, so it came in much stronger than I expected. I think what it does do is verify what Sir Mervyn has been telling us over the last 4 or 5 months, and maybe I'm using the wrong term, that he wasn't really sure about the validity of some of the data coming from the ONS, mainly the consumer confidence and also employment. So I think what it does verify is that we are out of the recession, okay? But I still am not expecting any more than growth for all of 2012 to be 0.2. So I don't think it's something we can really get that overly exuberant about.
No, sure, but at least it's sort of move in the right direction. I think next week, obviously, we'll be into that November month, and we can almost sort of look forward to the end of the year. But you're very much of the thinking that maybe we'll see more downside. But do you see that prolonged? Because, of course, November and December are historically very bullish months.
Well, I think one of the things you have to look at is, if you look at the U.S. presidential election, remember, it's only the 6th of November. You know, the question is, history has shown us if we have a Republican president, we get a massive 12 to 14 month, improvement in both the US indices. Well, if that happens, will that lift the indices here in Europe? But I think one of the things, and again, I'm not trying to be a doom and gloomer, but I think if towards the end of the year, if we go back and look at the gurus' predictions in January for 2012, I think most of the indices have done far better than people were expecting. I was not expecting, 5,800 plus for the FTSE. And I think, again, it's certain institutions, whether they be commodity related. And I think one of the things, as we saw today, we've seen a very strong move in gold. We're seeing a very strong move in sterling, okay? Now, my feeling is that if we can think back to Mr. Trichet just 3 years ago, his line in the sand for the euro was 132. We're well above 161 now for cable. Is that getting to a point where all of a sudden, is that going to hamper UK exports, especially in the automobile industry? And I think one of the things is that I'm still, and maybe I'm getting into a distinct minority, I still think there's probably a 40% probability that the Bank of England, when they meet on the 8th of November, and they all change depending on what happened 2 days before, but looking at the numbers now, the GDP numbers, the employment numbers, the inflation numbers, I still think that I could see the Bank of England adding another 25 billion quantitative easing, because we're not seeing spending. We're not seeing, the consumer still has both of their hands in the market. And one of the things that we've seen is, I think we've seen, and I don't know the exact statistics, but I think we've seen more individual mortgage pay downs in the past 3 years than we saw in all of the previous 25. So the consumer is trying to reduce their outstanding debt as much as possible.
And deleveraging is still very much going on.
Yes.
Okay, well, it's an interesting topic. I think there's a lot of things that we can probably discuss next week as we move into November.
Yes.
But once again, thanks very much for joining us.
Thank you very much.